Uncle Sam. Uncle Sam has gone a long way toward helping mortgages remain affordable. But what happens when the Federal Reserve starts raising interest rates? Yes. Where will that leave investors in the mortgage market? Well, Chris Harms is a fixed income strategist at CapitalSource Finance. Chris Harms, good to have you with us. Thanks so much for coming in. I haven't seen you for a while. Since the last time you were here, it seems as though everybody has fallen in love with high-yield corporate agency-backed debt, right?
Well, it was a great trade. When we talked about it the last time, spreads were at historical wides, record-setting double-digit yields. Those were things you just couldn't walk away from. But now they've tightened considerably, and most of that trade is over.
So what do? You walk away from it now, or do you just hold in the portfolio?
I think you do a little of both. You let some go, and you hold on to what you don't need liquid. We're going with a sort of a strategy of keep it short, keep it liquid, and keep it safe. Those are the three strategies, especially in the mortgage market. The mortgage market on the agency side has had a tremendous run, as you mentioned.
Thanks to, of course, the efforts on the part of the Federal Reserve, right?
Exactly. They've been buying most of the free supply in the marketplace, and it was needed. It was needed to take the supply out. Remember, a year ago, we had the conversation. We didn't know whether or not the markets would open the next day.
Right.
But they're liquid, they're functioning, rates are controlled. But we do know eventually rates are going up. The Fed told us last week they're not going up this month or next month, so the markets started to perform well. You should use this opportunity somewhere in the next 3 to 6 months to really start looking at your portfolio. One of the things that we're looking at and trying to take advantage of is trying to sell some of the fixed rate, or looking at not buying any more fixed rate and looking at the adjustable rate mortgage market. Ginnie Mae has full faith and credit of the U.S. government guarantee. So
that's what the G stands for.
That's what the G stands for. So there's your guarantee and there's your safety. They're liquid. They're the most liquid securities in the mortgage market.
But go with the floaters.
But go with the floaters because they're fixed now. Well, some of the things we're looking at are securities that have fixed coupons for the next 3 years, brand new issue. So the appraisals on the houses are new. So you know the market value, and you're not even worried about that right in the Ginnie Mae security because the government's guaranteeing it. So look at a 3%, a 3.5% mortgage for the next 2 or 3 years, and then after that, every year it floats.
You get the pop
off of a higher rate, and we know within 3 years. I don't know when. We don't want to be in the business of calling the day the interest rates rise.
Right. But you got that 3-year window. Okay, so you take the 3 years, that's fixed. But after the 3 years, you get whatever move.
A spread off of LIBOR, north of 100, 150 basis points, 1.5%. That's a good security with a good 10-year average life. Government, it's liquid, it's providing some yield. That's what we like, and that's what we're looking to continue.
Go back to the notion, though, of what to sell right now. I mean, you talk about short end of the curve. You want to be selling those? You want to be getting out of them? Or where do you want to be making the decision?
Again, in the mortgage market, you want to be looking at the securities that have run up in the last year. The biggest run-up we've seen is in the 5% type coupon because that's what the most liquid. The average coupon outstanding in the Barclays aggregate mortgage market is 5.25% right now. So the 5% mortgage today, just coincidentally, set an all-time high record of a $104 price. Those are the types of securities that if you're overweight and the Fed is buying them and people are looking to buy them, that's what you should be looking to peel away and go into the adjustable rate
Maybe go
market.
ahead and hit the bid. If someone's out there offering it, to take it.
Liquidity is great. We didn't have liquidity a year ago. So when there is some liquidity and you have some gains, especially going into year end, and you're looking to retail the portfolio for the next big trade. That was a big trade 6 months ago. We took advantage of it. Now you're looking for the next big trade, and we think it's in the adjustable rate market.
All right. I want to thank you very much. Chris Harms coming in from CapitalSource Finance, Vice President there. Appreciate you sharing your thoughts with us about the fixed income market.